Consumer sentiment just hit a record low. My guest today tells you why that could be one of the best buying signals out there. We also share not one, not two, but three compelling ideas tied to the consumer. Tune in for my full conversation. Tom Hayes, Great Hill Capital Management, right here, right now. Welcome to The Big Skinny with Lou Basenese, where we cover things in one headline that you should probably ignore, one chart you definitely need to focus on, and one high conviction trade idea so that we can hopefully increase your bottom line alongside ours. And today, I've got a good friend, Tom Hayes, founder of Great Hill Capital Management. Welcome, Tom.
So good to be here, Lou.
Man, good to have you back. Look, man, consumer sentiment hitting record lows, and it's almost like just the clarion call for everyone and to put the fear mongering in the headlines, right?
Yeah.
I think Yahoo's got one. Goldman Sachs warns U.S. consumers could have a few challenging months. You say this is total hogwash. Why?
Yeah, the death of the consumer has been greatly exaggerated. Never bet against the consumer when they have a job in the U.S. They like to spend. Now, historically, consumer sentiment, first off, hasn't been this low. Yeah. But prior to this, hasn't been this low since the lows in 2022, the COVID lows when we didn't know if we were getting a vaccine, the great financial crisis lows, the tech wreck lows. And then you got to go all the way back to 1981, the recession there during the Volcker era.
So some people must just hate Trump that much if they think the economic conditions are anywhere close to those times.
Yeah, it's mind-boggling. But in all of those instances, there's one common factor. If you bought consumer discretionary, if you made a bet on the consumer during those periods, right, you were rewarded excessively handsomely during those periods. So, you know me, I always like to take the contrarian trade, kind of run away from the crowd. And I love you for it. And then you bide your time because you're never going to get the exact timing right. You're never going to get the exact bottom right. But if you're generally in the vicinity, you're going to do very well.
So if we look back at those historical precedents, and I think you shared a chart that we'll put up on the screen too, of looking at the pullbacks in consumer sentiment, consumer discretionary, did the lows in consumer sentiment kind of coincide with the bottoms in the sector itself? Or?
That's right.
Yeah.
Yeah, it's pretty darn close. I mean, you even saw retail sales today came in better than expected. Watch what people do, not what they say. I mean, if you don't have a reservation in a major city 2 days before for a restaurant, you can't get in. It's just that simple. And it's, there's the K-shaped thesis, but I do think we're seeing real incomes coming up. And I do think that this is kind of temporary headwinds, a little bit of uncertainty around the war, around oil prices, around a short-term spike in things. And I think as we look back 3 months from now, certainly 6 months from now, it's going to be a distant memory.
What do you think the disconnect is? I mean, do you think it's fears about oil prices and gas prices going higher and the consumers just feeling one way but acting it different? I mean, what do you think gets behind this where it seems like it's such an obvious pattern?
Yeah.
And a contrarian one? Yeah. Why is everyone falling for the head fake then?
Yeah, it's usually rear view mirror. Okay. So when prices are accelerating and then they level off. When they level off, you're not getting greater inflation. You're at a higher level. But we've just come off a period of rising prices. And probably the fear is the expectation is that they're going to keep rising at the same pace in the future that they have in the recent past, extrapolating the recent past into the future. And often it just doesn't play out that way. Maybe they'll go up, but they'll go up at a slower pace. And I do think you will start to see, as you saw in the first term of President Trump's presidency, real wages at the Main Street level actually doing better than, his first term was okay for Wall Street, but it was much better for Main Street on a relative basis. And I think we're getting to that inflection point in his second term that we're going to start to see that in the back half.
Yeah, I agree. I mean, we saw the first wave of that with the tax refunds, right?
Yeah.
For the reduction of no tax on tips.
Yeah.
I feel like the back half of the year, you're going to see a real wage growth, and that's going to be a catalyst that hopefully syncs up reality with what the perception is for
refunds were up 15%. That's $36 billion of extra money. Some of it was sopped up by increased energy prices, but that's such a smaller part of people's spend than it was, call it 20 some odd years ago. So, unemployment's still at 4.3%. You don't want to get too bearish on the consumer.
No, I agree. So consumer sentiment is a lagging and just contrarian indicator right now. Do you look at the discretionary sector as a whole and say like, hey, it's undervalued, you can be indiscriminate and just buy the basket? Or do you think you should be more of a stock picker in this type of a stage of a bull market?
Yeah, I kind of get to the conclusion from what the companies are showing me. So I'm like, I'll look through a bunch of companies. I'm like, why is Nike down so much? Why can't you give a restaurant stock away?
Yeah.
Why are all these clothing companies in the gutter? Why are, was Disney kind of languishing for a while? And then I say, oh, wow, if I look at consumer discretionary relative valuation to the S&P 500, you got to go back again to 2022 and then back to the great financial crisis. So these are like extreme multi-standard deviation events that I look for where it's like, where is the value per dollar? Where's the highest and best use of my capital to get the greatest expected return in the intermediate term? When you buy something down 80%, it could go down 85, it can go down 90%. Right. That means you're down 40, 50% in the short term before you get your double, triple, quadruple over a 3 to 5 year time frame, which is why you own more than one stock. And that's portfolio management. So what I'm seeing a consistent theme of, whether it's Nike or whether it's the experiences or whether one of our holdings, VF Corp, which I'm sure we'll talk about, or Disney is, and restaurants have had that acceleration of, wages a little bit, acceleration of input costs. And I think we're going to start to see that level off. I mean, beef prices can't get much higher.
That's right.
I mean, at some point they're going to start making cows one way or another, either synthetic or actual.
They tried that Beyond Meat, epic failure, right?
Epic failure. I remember seeing, I won't say which one of the CEOs of one of those fake meat companies in the green room one time. And I was like, well, why don't you just, if you're so confident about it, like, why don't you just do a taste test? He's like, yeah, that's a bad idea.
Yeah, let's not do that. Let's not do head-to-head comparison. So, all right. And like, I love you for this, the contrarian setup. You look for those signals where most people aren't. I mean, I would say it's like energy in the middle of last year. It was hated, underweighted, undervalued, and these pendulums, they go gradually and then suddenly, right?
For sure.
And then energy took off. So consumer discretionary, I think about that, the energy setup, that analog to last year, sounds like it's a similar one. You talked about VF a little bit. We'll get back to that one, but let's start with Papa John's. You think this is a great pick? No self-respecting Italian, myself included, would ever consider eating Papa John's, but why am I wrong?
Listen, I'm from New Jersey. We're fellow paisans to a lesser extent with the Irish last name, but I know good pizza. I would say, look, Papa John's is pretty darn good by California standards. The big thing here is, so they've had a problem. They kicked out the founder. That's always a mistake because they're the lifeblood. So they've gone through all these CEOs. Now they've got Todd Penegor. He came from Wendy's. He turned around Wendy's for Nelson Peltz. And he took Wendy's from the number 3 burger chain to the number 2. They took out Burger King under his tenure. He had a 3-bagger in the stock. If you could turn around Wendy's, you can probably turn around anything. So what did he do? He brought in the guy from Domino's. And for anyone who follows the stock market, Domino's has been one of the biggest growth stocks for the last 15 years, highest overall returns. And they don't sell pizza like that you and I would appreciate. They sell pizza that I would argue is not as good as Papa John's. But
I'll agree with that. If I had to choose between Papa John's and Domino's, it's Papa John's. And you got to try the new pan pizza. They're going for a Michelin star. It actually is good. Did that sentence just come out? Like, is that true?
They're legitimately trying to get it submitted for a Michelin star. I would say if you get it hot, it's not out of the question that they would get one, maybe. They have this Parmesan crust. You got to get it with pepperoni. I'm not usually a pepperoni person, but there's something magical about the combination. But the point is, the guy who ran digital for Domino's, the reward system, the order tracking, the app, he poached him and he brought him to Papa John's, and they're implementing it. I got to tell you, I don't understand how they did it. It takes me 11 minutes to drive to the store in California. I ordered on the app. We had a piping hot pizza at our house in 9 minutes. I don't know if they've got them in Tesla plaids. I don't know how they cooked it, but it was delicious. The girls were happy. So
there's something to be said about that too. I was talking about another companies in terms of the buy now, pay laters. They make the user interface so frictionless, so seamless that it's almost impossible not to use it. And I know Domino's did that. So now you're saying that they're taking that over to Papa John's. So
taking it over.
I'm becoming a believer gradually. Where's the valuation? Like, how do you think of this in multiples of upside versus, percentage of downside risk?
I think it's a double plus Earth Capital is a Qatari fund. They've got a pretty big holding in it. They made a bid for it last year at $60, Apollo backed. This year, they made a second bid at $47. Management and the board should not sell it, okay? Because then they're robbing upside from people like me. This thing
Brian
could be
Brenberg, by the way.
And Brian Brenberg. This could be a double plus over a 3-year time period, maybe more. They've got 6,083 stores. They're 1 or 2 in the top markets all over the country. They're 4 in the whole country. International is growing, which is good because that's an FX tailwind. US has languished a little bit, so international up a few percent, US down a couple percent, but they're fixing it. And I think the digital is going to be a good story. And they're refranchising a lot of stores, so that's going to increase margin and shutting down unprofitable stores.
And I didn't realize they were only at about 6,800 locations in the U.S. That's not overly saturated in any way.
No, not at all. Not at all.
Compared to like McDonald's, Wendy's, and other things that people associate with.
So you got Jockey, you got a plan to turn around, you got the growth. You've got taking costs out of the business, all your typical turnaround plays, and solvency risk is not an issue. They've got no major maturities till several years out. So,
all right, you've convinced me on the stock, but not on the pizza yet. But
I'll try you got to try it.
All right, let's talk another name, Cooper Standard.
Yeah,
another name you love, and then let's end with VF. So normally ask for one high conviction, but this is what I love about your strategy. Contrarian.
Yep.
Highly concentrated in undervalued names so that you're reducing risk just by the value purchasing price, but also preserving a ton of upside. So why do you like Cooper Standard?
Cooper Standard, we've been in since May of 2022. We went public. This was a stock that was down from $146 a share at the last auto cycle peak in 2017. It dropped to $5 a share.
Oh my goodness!
We bought a ton of stock at $5 and change. It immediately went to $3.50. We bought more. And then they refinanced the debt, which was part of the thesis. So first we looked for management. Management owned stock. They had skin in the game. They're incentivized on return on invested capital, so their incentives were aligned. I was surprised by that. They personally had a lot of stock, so. They had to refinance the debt, which they did, and they've just refinanced the whole tranche in the last 2 months. So that solvency risk is off the table. So now growth. They've taken $100 million a year out of the business in cost since the 2017 peak.
Okay.
$700 million out of the business. Now,
what do they do exactly? For people that don't know.
They make the sealing systems around the doors and windows for new cars. Ford, GM, Stellantis are their biggest customers. So that rubber stuff around the windows, and then fluid transfer, fuel delivery systems.
Okay.
They do that type of stuff. They're number 1 and number 2 in both of those categories. It's a cyclical business. If you look at U.S. auto SAR, the sell-through every year, for the last 45 years, it troughs at 15 million units. It peaks at 17 million units. The last peak was 2017 before COVID. They earned $7.26 a share. They traded at a 20 times multiple, $146 stock. What's different this time, we're at 15.3 million sell-through right now.
Right at the trough, basically.
We're basically at the trough. The difference with this cycle is they've taken $700 million of costs out of the business. So when we hit that trough 3 years out, it's not going to earn $7 a share. It's probably going to earn 10, maybe 11, maybe $12 a share. Then the question becomes, is it a trough multiple 10 times or a peak multiple like they got in 2017, which would be 20 times? Then you got a $100 to $200 stock on a $5 basis. It gets interesting.
Yeah, that gets really interesting.
On a $30 basis, it gets interesting.
Yeah.
So that's where we are now. It ran up to 45, ran back down to 27. Now it's like 31. It's working its way back up. And all their assumptions are kind of predicated on steady volumes. And I don't think we're going to have a 17 million peak this time, because if you go back to 85, the population was 30% less.
Yeah.
We have record people getting licensed to drive nowadays. We have record number of people 34, 35. So they're buying more cars because they're moving out to the suburbs, family formation. Once Warsh gets in and cuts rates, people actually buy homes and make babies and buy cars. So there's a lot to like, and management has done an incredible job. The most important thing about this management, other than their execution, and when I initially met with them when we were starting the position, is they respect equity. Most management in that situation with the stock down, they would just scramble for survival so they could keep their stock and issue a ton of stock at a low price and screw the owners. And they did not do that. They worked through it. They did the hard things. They made the hard cuts. And now the operating leverage is incredible. So kudos to what management has done and what they're going to do. They renegotiated the contracts. So these short-term inflation bumps, all their contracts are now inflation adjusted. So it doesn't impair their margins. And just honored to be partners with them.
No, that's great. I mean, it looks like things are turning in the right direction, up
Yeah.
from 5 to 30, and you still see plenty of upside. So from pizza to automobiles to sneakers, just tell me it's not Allbirds that's going to pivot to AI.
No, it's not Allbirds. So VF Corp, this is another turnaround Tom special.
You better trademark that, man.
Yeah.
You're Intel,
Yeah.
Disney. For those of you listening, like this
Yeah,
man,
yeah,
I've learned to never bet against Elon Musk and never bet against Tom Hayes, because
Thank you.
you get deep valued names, Contrarian, and they turn out really well.
Yeah. Intel's moved quite a bit.
So VF Corp.
VF Corp. Bracken Darrell, new CEO, came in a couple years ago. He's doing his playbook that he did at Logitech. He became the CEO of Logitech in 2013. The stock was down 86%. If you had invested $1 million when he came in, you made $26 million, 26 bagger in Logitech. They didn't cure cancer. They didn't win the AI race. They sold commoditized mice and
Keyboards
webcams.
and webcams, right?
Absolutely nothing special. And he's doing exactly what he needs to do. So what's the first thing in a turnaround? Number one is management. We know we've got proven management. Number two is solvency risk. First thing he did, he sold Supreme and he sold Dickies. That took $2 billion, took $2 billion in, paid down debt, solvency risk off the table. So now you're left with North Face, which is hitting on all cylinders, Timberland doing perfectly fine, JanSport, Eastpak, everyone that goes to school has one of those, Ultra, which is the number one trail running shoe now, it's growing like a weed, and then Vans. Vans has been the albatross.
Vans is your favorite.
Has been the albatross around the neck, but it's actually turning the corner finally. So he cleaned up all the distribution channels, all the wholesale channels, all the discounting, brought in the lady who did the design for Lululemon when Lululemon was working, and she's been brought on board, and all the channel checks indicate that Vans has bottomed and now starting to inflect. And if you even look at Google search, you can see the search volumes up depending on the unit, the type of up to between mid-teens to mid 30% in the last quarter. So
it's a big deal. And I love that Google Trends data is a sneaky indicator that you can use for any type of investment you're thinking about to see how are other people thinking about it. Right?
Yeah, that's for sure. I mean, in California, everyone wears Vans, but it's a very cyclical business, been around since the 60s. It's durable, we know, but every 3 years, people have three pairs of Vans in their closet, and then they, for 3 years, they don't wear Vans, they wear Converse, they wear New Balance, they wear Nike. Now the Nike thing's played out with Air Jordans. Everyone had 3 pairs of Air Jordans, and now they're going back to Nike. How do we know? Because the fashion catwalk tends to lead the trends, and in France, they were doing all these high-end collaborations with luxury brands selling like $300, $400, $500 Vans. And that usually starts, people get excited, the influencers get excited, and then the game is back on. And before you know it, everyone's wearing skate shoes for the next 5 years.
Well, and listen, we have very good proxies for this. Crocs has, tanked and surged multiple times. Birkenstock, another one.
Yeah. Doc Martens.
Doc Martens. You're saying Vans and
it's
the
its
whole,
time.
It's time. So interesting.
So, by the way, 10% of the portfolio was in growth mode. This will be the first full year of growth since 2023 for VF Corp. They've been trading in and out of brands since 1899. So this is not a fly-by-night. They're out of Supreme, they're out of Dickies. They'll be back in now that they're inflecting to growth margins are going back to 55%. They will get another, they'll be actually in acquisition mode. Now, they went through survival mode. They cleaned everything up. Once Vans is back to growth, they'll be buying a new brand.
Yeah. Interesting. Another interesting setup. All right. If you haven't noticed, we're all about all filling, zero fluff. And so is our email newsletter, where we deliver insights, one headline that you should probably ignore, one chart you should absolutely pay attention to, and one investment idea that you should follow to increase your bottom line right alongside ours. So if you're not signed up yet, go to thebigskinny.com, sign up for our newsletter. If you can't be bothered to give up your email address, that's okay. Give us a follow on Twitter or on YouTube so you never miss another episode. Before you run, a couple other quick, I want to get your thoughts on private credit. You think it's contained or still contagious?
I think it's going to get bailed out by Warsh, and the can is going to get kicked down the road for another 3 to 5 years. It's eventually going to be a problem. It's marked to make believe, but they're going to refinance and they're going to live to tell the story, and that'll be someone else's problem a few years out.
So it's contained.
Yeah.
AI, a bubble or ready for the next phase of a breakout?
Fourth or fifth inning, I think you're going to get a better opportunity to buy them in the fall. what's going to happen is, and the markets kind of sniffed this out in the first quarter, operating cash flow to CapEx is, mid 90s now. Free cash, you're going to see free cash flow negative among some of the Mag
like
7
Oracle
for the first time in a long time. And what's going to happen is one or two of them are going to blink. It's probably going to be in the third quarter, second quarter earnings, and they're going to say, we're pulling back on CapEx. And then everyone will throw out the AI trade, and that'll be like your final chance to buy it for the next 5-year run. I think
so. You think we'll get this stair step down in valuations from a 40x multiple to like 20x for the tech sector? You think we get another leg lower? It's a capitulation point where you want to load up for the last kind of run.
I think what you're going to see in the next few weeks. Relief rally here. This is going to continue. There's still a lot of people off sides from a couple weeks ago. Record puts, record selling in the hole. So this has got to run, which means software's got to run, Mag 7's got to run, and then sometime in the fall, going into the election, we're going to have some volatility. That'll probably be part of the catalyst. They'll always test a new Fed share. That's how it goes. And when everyone says the AI trade is done, there's no return on invested capital. This is all just spend, like kind of they did with the metaverse with Zuckerberg a few years ago. That'll be kind of like a really good time to buy. I think, that. And if it's not, then I just won't have them. It's fine. That's
the benefit of running a concentrated portfolio if it doesn't work out in the right way. All right. So is the gap between your golf handicap and my golf handicap going to get wider or narrower this year?
Well,
how bad I play.
If you get just a little bit better, it should get narrower because I got down to a 9. I was really playing well. I'm back up to a 10. I think I can get to a 7 by the end of the year. I'm kind of dialed in. I'm making a few bad mistakes here and there, but I'm posting a lot of 41s. I haven't posted any 39s lately, but I can sniff them out. We'll see.
I think I've posted a 39 on a couple individual holes, but for the record, you're at a 10. I'm at a 21 and trending down. So we'll touch base in 6 months and see where it worked out. Any other thing that's kind of bubbling up in the market? I think you're a very patient, astute investor. You wait for your right spots. You pick them wisely. You go in with conviction. There are something you're monitoring that other people really aren't paying attention to.
It's funny. I was talking to a group of entrepreneurs, all mostly 9-figure guys, and they're all like, market's at all-time highs. How much cash should I have? And I said, listen, instead of cash, there's always something to buy, no matter how high the market is or how low the market is. And the thing that's available to buy when the market is out of favor is usually defensives. Right now, staples are trading at yields that you could get maybe 2 times in the last 50 years. And it reminds me a lot of the Buffett trade when he bought $1 billion of Coke in 1989. Today, his dividends from that basis are nearly the amount that so he gets like almost $1 billion in dividends for his initial $1 billion investment, even though the stock's up many bags on top of it. So, and I'm not endorsing any of these, but I said to them, if you just got a basket of, Conagra's at 7% yield, General Mills, McCormick that does the spices, Hormel Foods, which we own, Skippy, Spam, a lot of protein type.
The grocery store aisles of defensive picks and
Planters, peanuts, all of this stuff. They've had some margin compression. That's part of the reason they're down. I think that's kind of rear view mirror again type of situation. But basically the blended current yield on a basket of these high quality that have been around for decades. They're not going anywhere.
GLP-1s aren't putting them out of existence.
They'll just change. If people don't want Oreos, they'll make them protein Oreos. They'll figure it out. Okay.
Sounds disgusting.
Yeah, exactly. So the beauty of that is that the yield is high because the price is down. And I think, Campbell's Soup, they own Goldfish. It's not just soup. People's like, well, I don't eat soup, but look at their brand portfolio.
Right.
You buy a basket of 8 or 10 of these, they're all down 50% or more. They all blended yield of 7%. Here's what's magical about it. 10 years out, they're all growing their dividend at about 5% a year.
Okay.
So this is what happened to Buffett. So you wind up, let's say you put $30 million into this basket, okay? Or let's just do 30 million. This is the group I was talking to, so it's fresh in mind.
I was going to say 30 million is not my first allocation number. But
okay. So 30 million, you got $2 million a year coming in dividends to start with.
Yep.
Which is $180,000 a month. I know it's tough for you to live on $180,000 a month, Lou, but some people can manage scrape by. $180,000 a month, 10 years out, not only are all your stocks probably up 2.5, 3x, okay, so you've made that capital appreciation. The 60s now 75 million, but your income has doubled because they've in aggregate raised the dividends over that time. So you got $4 million a month, $75 million, and you took de minimis risk. You didn't predict who was going to win the AI race. You know, I always talk to people. I don't know if you allow cursing on it, so I won't curse.
Fuck no, man. What is that?
I always say anyone who tells you who's going to win the AI race is full of shit.
Yeah.
Because at the end of the 90s, you know, there's a company called Excite, okay? $8 billion valuation. It was going to change search. You had Netscape. You had AOL with a $200 billion valuation. How did they screw that up? Yeah. Okay? All these companies were going to change the world. So then the NASDAQ crashed 80%. And in 2004, this little company called Google went public after no one was interested in search.
And one of the only Dutch auction IPOs, I think, ever, right?
Yeah.
Like a true Dutch auction, yeah.
And changed the world. Yeah. So you don't even, like the people gambling and guessing on trying to ride the winning horse, some are going to gamble and win, and people are going to attribute that to being lucky. Yeah. And they write books about the people who take a 1 in 1,000 shot and win. They don't write books about the 999 who failed. That's why we bet on boring businesses that are predictable, that we can make doubles and triples, rinse and repeat. And when you forget that, and at the moment you think you're going to guess who's going to win the AI race, just log on to askjeeves.com to do your next search, and it'll tell you everything you need to know.
Very well put. Look, I think I love this about you. Tell people where they find you, because one of the great pieces of advice, in addition to all the investment ideas you've given me, you have a podcast that's now 3 or 4 years running.
6. It's 300. Will be episode 340 on Thursday.
You told me when I started this podcast that at least you got to be committed and consistent, because it took you over 2 years before you got your first client from it. So now you're 6 years in. Where can people find that? What can they expect when they listen to your episodes? More of the same of this, ideas? Take me through what that involves.
Hedge Fund Tips with Tom Hayes is more about it's number one in its narrow category, which is the hedge fund category. Toggles between 1 and 2. We go through a lot of market data, which you do a great job of here. We go through 2 of our holdings every week. So we're basically updating clients, and everyone can listen in for free.
I love it.
And then we take Ask Me Anything questions from the audience. So people will send in companies that they're looking at. We'll go through balance sheet, income statement, cash flow statement in real time. And we'll be like, here's why we might be interested in doing more work. Here's why we would take a pass. People find that extremely valuable. So that, and then we do the weekly article at hedgefundtips.com. So that's where they can find the podcast and everything else. And then our day job, which is what we do for a living, is on the golf course. People say, "What do you do for a living?" I say, "I make rich people richer," aka God's work. But in seriousness, we manage money for family office, ultra high net worth individuals, concentrated equity, kind of Buffett style, but more like what he did during his early partnership days when he was buying out of favor turnaround situations. And that's when he had the best performance of his career in those 10 years running the partnership. Yep. So we have like a little bit of our secret sauce, as you've seen how it's evolved over the years.
And a great track record 3 years in. So I encourage people, hedge fund tips.
Yeah. And the site for that is greathillcapital.com.
Great Hill Capital, in case you're in that bucket of $30 million allocations. Not a solicitation. Fully disclaimed.
Not advice.
That's right. I'm not doing any of that. No tax, none of that here. But always a pleasure, man. You're a great all-around guy, a friend in the business. I'm thankful for your friendship.
Thank you.
But even more thankful for you being willing to share your insights with us.
Likewise. Thanks, Lou. I appreciate it.
Hope to have you back again soon.
I'd love it.